Aloha folks, thank you so much for checking out this video. If you are new to my channel, my name is Mark, Mr. Dividend Investor. In this video, we are going to look at a company that one of my viewers have requested. So hopefully you like this company. I know this company well. I think it's a solid company. So just a little bit info on this. It is a company that has been outperforming the S&P 500 for the past 5 years. Hedge funds have increased their position last quarter. It is a company that's been giving dividends for 47 years, and in the last 5 years the dividend growth is 13% per year. So if you want to check this out, do me a favor and hit that like button. If you're not yet a subscriber, hopefully by the end of this video you will subscribe. As always, please remember, this is not financial advice. This is just me sharing so that you can make better decisions on what kind of companies you want to invest on. With that said, let's take a look at this company. So the company I'm talking about is Automatic Data Processing. Ticker symbol is ADP. This is a global technology company that engages in cloud-based human capital management. What they normally do is HR, payroll, tax and benefit administration. So if you go and check out their website, you can see a little bit more. They do a payroll and HR tech, trusted by more than 920,000 clients. You can see they range from like small businesses to mid-sized to large businesses. As you can see, all these things, they do time and attendance, HR, payroll. They also have all these information. They also have many awards, as you can see from their website. So definitely check it out if you want to learn a little bit more about it. Now, if we go to Yahoo Finance, at the time of this video is at 227. If you look at the 52-week range, the high is 261 and then the low is 192. And then you got your PE ratio of 32. You got your market cap of 94 billion. You got forward dividend yield at 4%. And then you got your performance outlook. Now looking down to the earnings, you can see 4 beats for the past 4 quarters. And then if you look at the financials, just looking at the chart alone, you can see a steady increase of revenue from 2019 on to 2022. So the latest is 16 billion. The last year of 2021 is 15 billion. If you look at the recommended trends, a lot of holds right now with some small buy. And again, the rating is a hold. Price target is at 246 and currently is at 227, so you're pretty much paying it below the average. Now, continually staying with Yahoo Finance, I wanted to compare it to the S&P 500. As you can see, the S&P 500 is the blue, and then you got ADP as this one. So just looking at the chart, it has been neck to neck the past couple of years, and then you see a little bit more breakaway in here. But then if you look at the 2 years one, we're pretty much the same. Has been beating the S&P 500 pretty much the past couple of years. Now, who are the top institutional holdings? You can see Vanguard has about these much shares, followed by BlackRock, State Street Corporation. You got Bank of America, Wells Fargo, Charles Schwab, and then you got Morgan Stanley. So pretty well-known, established companies. Yeah. Now swinging to CNN Business, based on their price forecast, you see a high of 280, a median of 248, and then the low of 208. And then recommendation is pretty much similar as a hold. And then if you look over here, shareholders, you can see some of the buys and sells of the institutional inside trading. So here's the inside trading, and then institutional holdings, as you can see. The transactions of buy and sells right here, you can see. Now looking at Webull, based on their analysis, there's 21 of them. They rated as a hold. Only 14% said is a buy, 4% said is a strong buy. If you look at the price target, you can see a high of 280, 246 is the average, and 208 is the low. Now if we go to tip ranks, their analysis rating is a hold, 4 holds and 1 sell, and then you got your target of 234 with a 3% upside, with the highest about 248 and then the lowest of 210. Now if we go to some of the stock analysis, you can see smart score of 9, which is outperform, and then you got your hedge fund holdings have increased. So if we go to that, you can see the confidence is positive, and then hedge funds increased holdings by 44 shares last quarter. Now if we go to Simply Safe Dividend, based on their dividend safety score, they rated as 97, which is safe. The dividend yield is 1.83, and then you got your beta over here. Now looking at some of the key metrics, payout ratio is 58. During the recession, they've increased it. And then if you look at the dividend growth, the last 20 years, 12%, which is fast, very fast. Last 5 years, 13%, which is very fast. And then you got the latest is 12. Again, beautiful upward trend. And then uninterrupted dividend streak of 47 years without a reduction, and increases for the last 47 years. So pretty solid. And then your payment details, quarterly, the months of January, April, July, and October, and then your annual payout would be $4.16 per share, which breaks down right here to about $1 per quarter. Yeah. And then over here you can see, based on Simply Safe Dividend, they feel it's overvalued. If you look over here, the dividend yield is below the 5-year average. And then here's your pay ratio, 28. And then the price range is right in the middle. Yeah. Now going along to, you can see some of the information, sales growth, total sales in billions. And then return on investment capita, 56%, last 12 years. Return on equity, 66, 12 months. Now if we swing to bar chart, based on their price target, a high of 280, 240 is the mean, and 210. And then they also feel it's a hold too, based on 13 analysis. So it's pretty consistent. Many of the sources that I provided are pretty much on hold, as you can see in here. Now if we go to Stock Rover, based on their analysis, it's also a hold, and then there's 13 of this with 2 strong buy, 10 holds, and 1 strong sell. And then you can see the average strike is pretty much similar. Now if we go to industry versus the risk and return, you can see the comparison between the industry and S&P 500. 5-year return, you can see 122%. S&P is 58. You can see the growth over here, and then you're in the profitability right here. Price to book ratio is 29, and then the dividends, so you can see right here, 5-year average of 12, 3-year average of 9, 1-year average of 11 versus the S&P 500, which is here. Now, looking at simply Wall Street, and then you see the overview. Trading at 18% below estimated value, pays a reliable dividend, has a high level of debt. So if we go a little bit more in there, you can see some of the positives and negatives in here. Now, if you look at the valuations, you can see a little bit here. And then you are seeing fair value of 279. Currently it's at 227, 18% undervalued. Okay. Switching to Google, the 5-day is about -1. 1 month is -7. 6 months is down 2%. Year to date is down about 7%, and the year is up 11%. 5 years is up 99%. So you can see from there, yeah. 52-week range and a 52-week high. All right, that's about it. I think for me, it is a solid company to invest on. I used to invest in this company. I haven't done. Thinking about probably going back on it and see if I'm going to start stuff. So I still need to kind of think about it, because I'm focused on other things, which I will do a video on what stocks I'm buying in the next couple of videos. So stay tuned to that. As always, please remember, be safe, stay cool, keep investing. and I'll catch you guys in the next video, right? Take care. Aloha.